Shorting the dollar. How modern finance bets against its own currency. Modern finance operates as a coordinated leverage system in which governments, corporations, and individuals borrow increasingly cheap dollars to acquire higher yielding or appreciating assets, creating the appearance of wealth while quietly eroding the currency's purchasing power. What looks like rational, profit seeking behavior at the individual level is, in aggregate, a structural bet against the long term integrity of the dollar itself. The system sustains itself through asset inflation, continuous credit expansion, and maintained confidence. But beneath it all lies a growing tension between nominal gains and real value, where the very mechanism used to generate returns is the same one steadily debasing the foundation those returns are measured in. Section 1, Thesis. The contemporary financial system functions as a massive, economy-wide domestic carry trade. Participants borrow in USD at low or moderate rates, deploy capital into higher return USD-denominated assets, stocks, real estate, corporate preferreds, Bitcoin treasuries, and rely on asset appreciation plus mild inflation to outpace borrowing costs. This creates widespread nominal wealth but structurally shorts the dollar's purchasing power. In aggregate, it is not wealth creation, it is credit-fueled dilution masked as growth. The game persists only as long as asset returns exceed debt service and confidence holds. When that equation flips, the unwind is swift and painful. Section 2, Grounding, the mechanics at work. At the micro level, the strategy appears logical. Consider a concrete example from April 2026. Strategy Inc., formerly MicroStrategy, rebranded in 2025, CEO Fong Lei publicly stated he invested $250,000 personally in the company's variable rate Series A perpetual preferred stock, ticker STRC. This instrument currently yields 11.5% annualized, paid monthly in cash, with the rate adjusted to keep the trading price near its $100 par value. Lee contrasted this with his 1.75% 30-year mortgage locked in years earlier, framing the spread as an attractive arbitrage. Borrow cheap, invest higher, same currency. This is not isolated. Homeowners with sub 3% mortgages from the low-rate era treat their homes as leveraged inflation hedges rather than paying down principal. Corporations issue bonds or preferred shares at yields below expected equity or asset returns, using proceeds for buybacks, acquisitions, or treasury bills. Sovereigns roll trillions in debt at rates historically below nominal GDP growth. Banks and investors chase yield in a world where cash or low-risk instruments deliver negative real returns after inflation and taxes. Borrowing itself expands the broader money supply, M2, through credit creation, even if it does not directly print base money like QE. Fixed-rate debt becomes a de facto short on real purchasing power. If inflation exceeds the coupon, the real burden shrinks. Today, 30-year fixed mortgage rates hover around 6.3 to 6.5%, while headline CPI inflation has recently ticked to approximately 3.3% year over year. For legacy low-rate borrowers, the real spread remains favorable. For new entrants, the math is tighter, but the incentive to leverage into appreciating assets persists. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 3, Catalysts, why the system encourages this behavior. 3 interlocking forces drive the dynamic. Policy design. Central banks and governments have prioritized growth and debt servicing over strict purchasing power stability since the end of Bretton Woods. Mild inflation, targeted around 2%, though recently higher, eases the real weight of legacy debt, discourages hoarding cash, and supports asset prices. Preserving zero or negative inflation would raise real debt burdens, trigger defaults, slow growth, and crash collateral values, politically and economically toxic in a highly leveraged economy. Incentive alignment at every level. Individuals optimize personal balance sheets. Net worth, assets minus liabilities, matters more than currency purity. Corporations maximize shareholder value through leverage. Governments finance entitlements and deficits cheaply. The USD's reserve status keeps Treasury demand high, suppressing yields relative to other currencies and enabling the carry to continue. Asset inflation feedback loop. Credit expansion bids up stocks, real estate, and alternative stores of value, including Bitcoin. Higher asset prices justify more borrowing, which funds further purchases. Strategy's STRC structure exemplifies the flywheel. Issue preferred capital at 11.5%, buy more Bitcoin with proceeds, pay dividends from new issuance or treasury dynamics, and bet that BTC appreciation outruns the preferred cost for common shareholders. It is elegant engineering until the underlying asset leg falters. This is not irrationality. It is rational response to rules that reward debtors and penalize savers. As Ray Dalio's long-term debt cycle framework illustrates, prolonged periods of credit expansion naturally lead to higher debt burdens relative to income and output. Zoltan Pozar's observations on collateral scarcity amid liquidity abundance add another layer. The system floods nominal dollars, while real productive capacity and hard collateral lag. Section 4. Real-world stakes. The stakes are systemic. U.S. federal debt held by the public stands near 101% of GDP in 2026 and is projected to climb toward 120% by 2036 and far higher long-term under current trajectories. Some estimates already place total public debt around 137% when including broader measures. Interest costs are rising as a share of the budget. If our interest rate on debt exceeds G nominal growth persistently, the mathematics turn ugly. More borrowing simply to service old debt. The slow death intuition, gradual debasement, is visible in the dollar's long-term loss of purchasing power, roughly 96% since 1913. Yet the more immediate risk is not steady erosion, but sudden loss of coordination. A Minsky moment where asset returns fall below debt costs, confidence fractures, or liquidity freezes. We have previews: 2008 deleveraging, yen carry trade unwinds, sovereign stress episodes. In today's environment, a sharp Bitcoin correction, housing slowdown, or spike in long-term yields could cascade across correlated leverage positions, including corporate preferred structures like STRC. At the household level, millions depend on home equity and retirement accounts inflated by this machine. At the national level, entitlement programs and defense spending rely on cheap rolling debt. The tension is clear. Nominal gains feel real until they are not. Section 5. Contextual clarity. The fork ahead. This coordinated leverage engine expands debt faster than underlying purchasing power, relying on asset inflation and controlled debasement for solvency. It connects directly to deeper debates: fiat versus hard assets, yield illusions in nominal terms, and whether real stability fixed supply stores of value like Bitcoin can coexist with or ultimately supplant the current framework. The system has demonstrated remarkable resilience through coordination, rescues, rate adjustments, fiscal backstops for over 5 decades. But resilience is not permanence. Each cycle raises the baseline debt load and narrows the margin for error. The real question is no longer whether debasement occurs, but whether the flywheel can keep spinning indefinitely without a reset when the asset return equation breaks at scale. In the end, modern finance's bet against its own currency is not a conspiracy. It is an emergent property of incentives in a debt-based fiat regime. It generates impressive nominal wealth in the short run while quietly transferring value from currency holders to leveraged asset owners. Understanding this dynamic is the first step toward navigating or preparing for what comes when the spread narrows and confidence wavers.